Have you ever followed what looked like a perfect textbook signal from your favorite indicator, only to watch the market do the exact opposite? Well, what if that signal was never really a signal at all? What if it was actually bait for a trap? Okay, let's really dig into this.
Welcome, everyone, to AI Explains ICT. In this video, we are jumping right into ICT's core content. Specifically, Month 4, Episode 13. We're going to be talking about something called divergence phantoms and the market maker traps that they create. I'd really suggest you grab a notebook because what we're about to unpack could totally change how you look at your charts.
All right, here's our game plan. We're going to start with why indicators feel so promising at first. Then, we'll look at the classic reversal signal you see in all the books. After that, we'll pull back the curtain and see how that signal is actually a phantom. We're going to shift our whole perspective to how market makers see things, break down a trap piece by piece, and finally, we'll talk about a whole new way to use your indicators.
So first things first, why are we so drawn to indicators when we start trading? You know, it really comes down to this promise of simplicity, a clear-cut, easy path to making money.
This quote from ICT, man, it just hits home for so many of us, right? We've all been there, staring at a chart, putting all our faith in some squiggly line at the bottom of the screen, just hoping it holds a secret code to the market's next move. It's a rite of passage for sure, but it's one we have to grow out of.
Yeah, the whole retail mindset is really built on this idea that indicators can somehow predict the future. We're taught to just hunt for 4 simple conditions. Is it overbought? Is it oversold? Is there bullish divergence? Or is there bearish divergence? It creates this belief that trading is a simple checklist. Find one of these and you've found your golden ticket. But as we're about to see, that's a really dangerous oversimplification.
Okay, so let's get specific and break down the exact signal everyone's taught to chase. This is what ICT calls a Type 1, or a classic divergence.
So here it is, the classic textbook definition you've probably seen a million times. For a bearish signal, you see price push up and make a new high. But at the same time, your momentum indicator, it just can't keep up. It makes a lower high. And on paper, this looks like the perfect sign that momentum is dying out and a big reversal is right around the corner.
Now, let's look at this US CAD 1-hour chart. See how price makes that little higher high? Now look down at the stochastic indicator below it. It's a super common tool for this stuff. It's clearly making a lower high. For most retail traders, this is like a giant flashing red light screaming, "Sell now, catch the top."
But here's where the plot thickens. What if this picture-perfect signal isn't a signal at all? What if it's just a ghost, a phantom, designed to lure you into a bad position?
This is the question you really have to stop and ask yourself. I mean, think about it. If picking tops and bottoms was as easy as just spotting a little divergence, trading would be the easiest job in the world. The reality is, it's way more complex because we're not seeing the whole picture.
And here's the fundamental truth you have to burn into your brain. Price is moved by gigantic pools of money, not by some simple math formula running on your chart. Price itself has absolutely no idea your indicator even exists. But you know who does? The market makers. They know exactly what signals you're seeing on your screen, and they use that knowledge against you.
So to really understand the trap, we have to stop thinking like a retail trader and start thinking like an institution. It is a complete and total paradigm shift.
This slide just lays it out so clearly. While retail traders are looking at their chart and seeing overbought or divergence, the big institutions are looking at the exact same chart and seeing giant pools of money, liquidity. While you're trying to pick a top, they are engineering a price run specifically to trigger that big cluster of buy stops, that's everyone's exit orders, that they know are sitting just above that recent high. See the difference? They aren't following signals, they are hunting orders.
And this brings us to what ICT calls Type 2, or hidden divergence. Now, unlike the classic kind that signals a reversal, this one is a trend-following signal. So in an uptrend, you'll actually see price make a higher low, while at the same time, the indicator makes a lower low. This is the real clue. It almost always shows up right after the market makers have grabbed liquidity, basically revealing their true plan to keep the trend going.
Okay, so let's put all these pieces together. We're going to walk through the exact anatomy of one of these traps step by step using that same US CAD chart we looked at before.
All right, step 1. We'll call it the lure. The market paints that perfect textbook bearish divergence. The retail herd sees it, their trading books all confirm it, and they start jumping into short positions, setting their protective stop losses like a nice neat row of targets just above that high.
Now for step 2, the hook. Price dips down just enough to look like the reversal is starting. This move is absolutely brilliant because it does two things at once. First, it triggers all the sell stops from the early buyers, letting the institutions soak up all those sell orders. And second, it gives all those new short sellers a little taste of profit, which confirms their bias that they were right. Now they're hooked. They're not going anywhere.
And finally, step 3, the trap is sprung. With all that sell-side liquidity now absorbed, the market just explodes higher, blowing right past that old high. This triggers all of those buy stops from the short sellers, which just adds more fuel to the fire. And just like that, the textbook signal has failed completely.
And now, in the aftermath of that trap, look at what was created. Price made a higher low, but the indicator down below cycled all the way down to a lower low. That is the exact signature of a Type 2 hidden bullish divergence. The whole setup, it was never a signal for a top. It was the footprint of institutions reloading their buy positions to push the trend even higher.
So, what are we supposed to do with all this information? Well, we don't just throw indicators in the trash. We just learn to use them for what they're actually good for.
This right here is the most important takeaway of the whole video. Stop using indicators to try and predict price. Instead, start using them to read sentiment. When you see that perfect textbook divergence forming, your first thought shouldn't be, oh, time to sell. It should be, okay, the trap is being set. And then you ask, where are all the stops and how can I trade with the institutions that are about to go hunt for them?
And that's really the question I want to leave you with. This is the big shift. From being a reactive trader who just follows signals to being a proactive trader who anticipates institutional moves. So, are you just reading the lagging output of a formula, or are you starting to read the intent behind the price action itself?
If this video helped you see the market in a new light, do me a favor and hit that like button. And make sure you subscribe to the channel. If you have any questions at all, drop them in the comments below and a real human will get back to you. Stay safe out there and happy trading.